US debt has jumped over 20% just in 2025, and this has been fueled by the rising government spending and the ballooning interest rate on the US debt servicing. For multifamily investors, this is not just a number. It's a signal for you to stress test your deals, secure financing, and focus on resilient assets. Once again, my name is Bibi Ofiri, and I teach people how to be financially free with multifamily. And today we'll be talking about the US deficit, how it has soared 20% since 2024, and what you as a multifamily investor should know and for you to start doing. So let's dive right in. So since the beginning of this year, I've been constantly talking about the US debt and what it means for you as an investor, not just as a multifamily investor. Today, I'm going to be talking to you about how the US deficit has increased to about 20% compared to the same time in 2024. What is the root cause and what you should do as a multifamily investor? The US has been spending deeper into the deficit territory. That is, they've been going deeper and deeper into the deficit territory. And many administrations have been saying that they will fix it, but what we are seeing is more. In the last 7 months, it has been of great concern because it has even gone deeper. Compared to this time last year, we've gone 20% deeper into our deficit. That is largely due to the interest to pay on our debt servicing because the current loans that we have are already ballooning. Remember, I did a video back in June that $9.2 trillion was going to be due in June and later part of the year. If you've not seen that video, now is the time for you to go see it. Based on that, our deficit is going higher because we are servicing some debt. And not just that, and due to the government spending as well, the government is spending on things like defense. So we're seeing a lot of military in different places of the country at this point. So all these things cost a lot of money, and other things are also making the deficit go high. Just in July alone, the deficit hit about $291 billion. Just for July alone, it has gotten to that level. It is fueled by an expanding social spending. But come to think of it, the tariff income, based on what they are saying, rose to about 273%, which is very impressive. But note, these monies are coming from businesses, are coming from you and I that are paying for those tariffs, because it's not other countries that are paying for it. Goods are imported into the country are paid by you and I, people that go to shop, by the wholesalers, by the retailers and all that, and they transfer it down to us. I also did a post about what the PPI report was for the month of July and the implication. It's gradually coming into the consumer's cart, coming into our pocket. So these are some of the reasons why we are saying that due to the tariff. Tariff has currently generated between 21 to 28 billion to the federal coffers. Over the last 12 months, between August 2024 to July 2025, the US has accumulated a rolling deficit of about $1.9 trillion. That's about 6.5% of our GDP. So guys, this is just deficit. I'm not saying the total amount we spend. This is just a 6.5% of the total amount that we generate. This is an example. We're generating $30 trillion. It means that our expenses have surpassed what we are generating. So 6.5% of the GDP, that is what we've accumulated in the last 12 months. That is ridiculous, guys. So between August 2024 to July 2025, our income rose to about 5.2 trillion. That might look interesting, right? But our spending rose to about $7.1 trillion. If this is a property, what that literally means is that the income we are getting is about 5.2 trillion and our expenses, it's about 7.1 trillion. If that is happening to a property, you know that you are on the line, on the way to foreclosure, because you don't have the money to service your expenses or to service your debt. That is what is happening to the US right now. We are spending more than what we are getting. So let's break down what is behind the number, how we're making the income and the expenses, what is driving them. Tariff played a big role. It drove up income, but it's not just enough. So this tariff, in quotes, custom duties are just temporary. It does not fix it on the long term. And currently it's being litigated. So we don't even know how long this is going to last. It might be brought down. So let's see. So the CRFBS adjusted August 2025 projects about 22.7 trillion deficit over the next decade. That is, what they're trying to say is with debt climbing from about 100% of the GDP today to about about 120% of the GDP in 2035. And they're also saying that the interest payment on our debt is projected to hit about 14 trillion in the next decade. So, for example, if tariff does not continue, it means that literally the deficit will climb to about 28.5 trillion, with debts reaching about 134% of the GDP. So this calls for great concern, guys. If nothing is done, if there's no way that the government is going to raise how we make money through various ways long term, it just means that our deficit will keep climbing way more than what we think it is right now. So these are just projections from different federal government bodies. In other words, tariff are not silver bullets. So it means that this current administration or whoever is in charge will need to look for other strategies or ways for us to increase our income, because based on recent projections, if we continue the way we are doing right now, tariff will not be able to fix it in the long term. And besides, if we're not able to reduce our spendings, it just means that our spending is going to skyrocket if nothing is done. So in other words, tariff is not just the tools that the federal government should be using. There are other ways we can do it. So it's just like in the multifamily, if we are seeing that our expenses is more than our income, what do we literally do? We start looking for what are the things that are eating up our income. We start reducing our expenses and looking for channels, other ways we can boost up on our income. That is literally what the federal government should be doing. In that way, they will be able to cut down on spending. But we know the current situation of the country. We know that this current administration is basically inflationary, but there's a good news for multifamily investors. You know that inflation is good for multifamily. That is, multifamily assets skyrocket. Multifamily assets become much more valuable during inflation period. That is, there's going to be increased rent. The value of the properties will go high due to inflation. So that is why we always say that multifamily edges inflation. If this current administration is inflationary, we as multifamily investors, we are on the sideline. We are standing by to take advantage of that opportunity. But we should also understand that inflation is not good for the US dollar or purchasing power. What you can literally buy with $100, you might not be able to buy it in few years to come. That is what it is. In general, that is not really good. So let's go into you as a multifamily investor, what you should be doing right now, because the cards are on the table. We know exactly what the administration is doing. We know that our debt is going to go up. Looking at what is going on in the country, we know that is going to happen. We also know that there's no real ways that they intend to make money. The tariff is temporary and it might be struck down soon. And if not, once this administration goes, then another administration might come in and pull down the entire tariff. And another thing is that this tariff is a burden on the American people as well, because we are the ones literally paying for it. So that is a short-term goal. We need a long-term goal that will help reduce the US debt. So what should you be doing as a multifamily investor? Number one is that you need to start stress testing your deals. You need to know at what point will your deals break. Where will you break even? What are the things you can do to ensure that, one, you're not just breaking even, you're also cash flowing. So you need to stress test your deals to know what that point is right now. Also question your assumption. So you have to assume that cap rates will go up. Even if you know that cap rate is likely to shrink, you have to assume that it will go up. That will also give you a conservative approach to your multifamily deal. In reality, if it goes up, because you've already underwritten to it, you can now adjust. The second thing is for you to lock in your rate. There is no room for variable rate now. Many people that did the bridge loan and variable rate, we know what that is doing to them. Some of them are underwater. Even if they have performed very well in their property, they are not able to exit out of those deals, or some of them are being foreclosed because of variable rate. So this is the time for you, because if inflation goes up, there is no reason why the Fed would reduce interest rate, because like I always say, and I'll repeat it again, the Fed has two main mandates. One is to reduce inflation and to increase employment. So if inflation goes up, you already know the toolbox that the Fed will use is to increase interest rate, to reduce the buying purchasing power in the market, and in that way inflation will go down. So if you know that is going to happen, then you need to fix your rate. Another thing you need to do is maximize your tax efficiency. The good news is that yes, we all have different opinions about the recent bill that was passed, but as a multifamily investor, it's beneficial for anyone that is into multifamily because you have the opportunity to have massive tax benefit. You also did a video about the new bill. What are the benefits with that due to you as a multifamily investor? So if you've not watched that video, I want you to go right ahead to watch it. It's going to be in my description box, so go go there and watch that video as well, what to expect. So this is the time for you to maximize, at least do your cost segregation, take out all the bonus depreciation that you have available, because you will need it to write off expenses and increase on the cash flow that you're going to be giving to investors, or as you as an investor would have. Another very important thing you need to do is double down on your market fundamentals. Like, we know the market fundamentals. You don't invest in places where they don't have population or where there is no population growth, employment growth and all that. You need to start investing in metros in strong in migration, places where people are coming in due to many reasons. It might be due to employment, it might be due to other factors. You need to focus on those areas because you literally need people to stay on your properties. Where there are no persons or where people are not, then how would your property be fully occupied? I will say this over and over again: maintain ample liquidity. This is the time for you to have reserves, because things might happen and you need to jump right in to fund those things temporarily until things start working out. So keep large, ample liquidity because you might actually need them. So in summary, this is my own take on it. Deficits and debts are expanding rapidly with structural drivers like interest rates and entitlement spending. If you don't know what that is, go and research. Outpacing the boost from tariff or other ways we've been generating income. Tariff can inflate revenues, but on the long term, no. And they are also a tax on the American people and can impact economic growth, raise prices, and burden households. Like I said, these things are gradually creeping into our pockets, whereby undercutting your investment fundamentals. For multifamily, the clear path is resilience, conservative underwriting, secure fixed financing or secure fixed loan or fixed debt, focusing in demand segments, that is places where people are moving in and boosting up the economy, and protect your returns through maximizing your tax benefit and market strength. So that is why it's important that you always listen to our market spotlight, because we will always bring exactly what is going on. What are the items that you will not be seeing in your regular or your traditional news? We'll be talking about it here, and really the aim or the goal is to ensure that you protect or you pivot or you look for alternative ways to protect your investment. So this does not only concern the multifamily investment business, it does concern any form of investment that you are into. You need to constantly stay focused on the market, and if you don't know where to get your information from, be sure that we'll bring it to your doorstep. All you need to do is to subscribe to our YouTube channel, which is BB Ofiri, and also on our Facebook group, which is official BB Ofiri. I look forward to seeing you in our next episode. Thank you and have a wonderful day.